Bank of Canada has increased the interest rates fourth time this year. So what the interest rate hike means for you and what is the impact of higher interest rates on variable rate mortgage, that is what we are going to discuss in this video, so stay tuned. Hello, this is Sonia, your local realtor with Remax Realty Specialist. The 100 basis point increase is the highest yet this year and the largest rate since 1998. In its press release, the Bank of Canada stated, with the economy clearly in excess demand, inflation high and broadening, and more businesses and consumers expecting high inflation to persist for longer, the Governing Council decided to front-load the path to higher interest rates by raising the policy interest rate by 100 basis points. The bank has also mentioned that Canadians can expect further increases. The next scheduled rate announcement is September 7, 2022. Prospective buyers, this may impact your stress test outcome. Mortgage holders are following the interest rate announcements closely but are still waiting to learn when the Bank of Canada expects to end the continuous rate hikes. Home prices are trending downwards in many markets, so although interest rates are rising, some buyers may be surprised by their expected monthly payments. Following all-time highs in February, prices are stabilizing and the market is more balanced across the Greater Toronto Area. The rising interest rates should not deter prospective buyers from entering the market, but it is more important than ever to work with professionals who can guide you in the right direction. If you're wondering if it is better to buy when interest rates are high and property values are low, or when the interest rates are lower and the property values are higher, don't forget to watch this video. As the interest rate changes, the stress test changes as well, often tightening the amount buyers are approved for. A general rule to use is that someone qualifies for about 10% less mortgage for every 1% their stress test increase. Buyers should work with their real estate agent and mortgage broker to calculate what mortgage they can expect to qualify for using different stress test scenarios. While the mortgage qualifying amounts may be decreasing, home prices across most parts of Canada have declined month over month in the past quarter. This may actually open up opportunities for buyers who were previously priced out of the market in early 2022. And now I'm going to discuss the impact on variable rate mortgage. According to Canadian Real Estate Association, the average home price in Canada in May 2022 was $711,316. A homeowner who put 10% down on a home purchase for $711,000 with a 5-year variable rate of 2.50, amortization over 25 years, has a monthly mortgage payment of $2,955. With the 100 basis point increase, the homeowner's variable rate will increase to 3.5%, making their monthly payment to $3,294, an increase of 11.5%. The homeowner will now pay $339 more per month or $4,068 more per year. This is just with 100 basis point. And here I just want to explain the difference between variable rate mortgage and adjustable rate mortgage. A variable rate mortgage is one where the interest rate changes with the market, but the monthly payments are always the same. The benefit to this is that it makes it easier for a budgeting standpoint. However, the downside to that is unless you voluntarily start paying more, it will take you longer to pay off your mortgage and cost you more in interest, and more of the payment will go towards the interest of your mortgage loan versus the principal, or your amortization period will increase. And now I'm going to talk about the adjustable rate mortgage. With an adjustable rate mortgage, similar to a variable rate, your mortgage rate is floating. However, unlike variable rate, your mortgage payment will change when interest change. If interest rate goes up, your mortgage payment will go up. If mortgage rate goes down, your payment will go down. There are pros and cons to adjustable rate mortgages. The pro is that you are forced to pay down your mortgage at the same pace you were originally supposed to. If the amortization period was 25 years, you are scheduled to pay it off in that time frame since your mortgage payments are adjusted as needed. If you have a valid pre-approval with rate hold, you might still qualify for the same amount for the period of your pre-approval, which is usually 90 to 120 days with most of the banks. Now, don't forget that all variable rate mortgages are given as prime minus or prime plus. Currently, there are still discounts available of 1% to 0.2%, meaning on the new prime, the rates will be 3.7 to 4.5%. The current fixed rates are 5% plus, which means that there can be still massive savings by choosing variable rate mortgage. In the current environment, it is very important for consumers to have a clear budget and financial plan in place. They should run different models with different interest rates to understand where they stand financially and how soon they will be in trouble, if any. It is essential that people pay off their expenses first and then build on their opportunities to plan and protect their savings strategically. In some cases, it might be worth refinancing now before interest rates goes up. One piece of advice that I would like to give here is please crunch your numbers again and look at different scenarios before you make any big purchases. And if you're considering of buying or selling real estate in Greater Toronto area, I'm just an email or a call away. Thanks for watching and don't forget to join me next week. Until then, stay happy and stay safe.